Okay, we're now on part 3 of our quadruplex investment problem. We have taken a look at the fundamental setup of the problem, where the income is coming from, where the expense is coming from. We've gone through our before tax cash flows, and we've come down to our after tax cash flows, at least for the first 3 years based on our income and expenses. Now we're going to sell the property in the third year and wrap it all up and decide whether we should make this investment or not. So let's jump right into it. Now we're going to sell this property. Well, the first thing that we need to do, of course, is figure out what the sales price is going to be. Let's add another sheet in here. I'm going to right click, insert, and we'll just select to insert another worksheet. And we will call this one our before tax equity reversion. Or BTER. So what's our future sales price? Now we know from our original setup that our future sales price is going to be our original purchase price plus some appreciation. So we'll go back here to our first tab, and we remember that our initial acquisition price was $325, and our appreciation rate, this was again over the whole period, not per year, is 12%. So we'll say $325 plus why don't we just multiply that by 1 plus our appreciation rate, and that'll make it real quick and easy, and that comes out to $364,000 is what we think we'll sell this thing for in 3 years, at the end of 3 years. But what was our commission? Now that's not just commission, that could be other things like attorney's fees and so forth. It's just our selling costs. So our cost is going to be equal that value, our sales price, times our selling cost. It's going to cost us $21,840 to get the thing sold. So our net proceeds are going to be our sales price minus our selling cost, $342,160. But wait a second, we still have to pay the bank. So we'll say this is our net proceeds, and then we'll take away our loan balance. Well, what is our loan balance? Well, if we remember from our amortization sheet, we have our original principal, and then we paid these payments. This was the interest and this was the principal. So what we owe is going to be the original balance minus what we've paid out on principal. So let's sum those principal payments up. We'll add those guys up using Excel sum function. And to calculate the balance of the loan at the end of this period, we're just going to subtract the principal payments from the original balance. Since it's a negative number, I'm going to add it here. So we end up with $235,700 and about $772 is the balance of the loan. So let's point to that. Again, makes this spreadsheet dynamic. So less our net proceeds minus our loan balance is going to tell us what our before tax equity reversion is. We're going to say 342 minus our loan balance. It's going to give us a before tax equity reversion of 106. But wait a second, that's before tax. We do owe taxes. Well, what kind of taxes do we owe? Of course, capital gains. Alright, so we have the net proceeds of the sale, and we know what those were. We'll just point to that value again. That's at $342,160. And we need to figure out what is our original basis. Well, our basis is what we have in the property, what we paid for the property. So our original basis is what we paid for it. So we're going to go ahead and point that back to that $325 that we paid originally at the very beginning, which is right there. But we've taken depreciation. We've written this thing down over the course of the last 3 years, but we need to add that back because we've written that off as we go, but because we're selling the property at a higher value than we paid for it, we ultimately do have a gain, so we need to pay taxes on that value. So we have to depreciate this property. So if you take a look at what we'll do here, we will depreciate the property, and we're going to add that back at a little bit lower here. For this point, we do want to group because we have different rate on the capital gain from the depreciation recapture. So what we'll do here is take out the depreciation in this point, which, if we recall, is this total of these three values here. It's going to be the sum of these three values right there. And we are also going to add our improvement expenditures. So we want to are going to add those improvement expenses. So we are going to get those improvement expenses, which were back here on this original tab, because we spent that money on the property, so that increases what we have in the property. So if we sell it for a profit, this will reduce the amount of taxes that we pay. So we're going to go in here and find the amount that we paid, which was $12,000 for our improvements, and we're going to add these up. So now what we see is the amount of money that we have in the property is $306,864. The original amount that we paid for the property, we've depreciated it, we've reduced the value on it by $30,000, but we spent $12,000, which increased the value of it by $12,000. Now keep in mind that the more depreciation that we have means that we're going to pay higher taxes on our capital gain, because it's saying that the property has down or is worth less on our original payment, but now we have to pay the tax on the difference between what we originally paid for the property and what we've written it down on depreciation, and then the sale price. So we ultimately will owe capital gains taxes on the difference between these values. So our capital gain is equal to our 342 minus our 306, which is $35,296. That's the amount of profit that we made on the building. Okay, well, how much do we pay in taxes? All right, well, let's take a look at the capital gains tax calculation. So we have two areas to consideration. It's the gain and then the tax itself, because we have different rates on these two components. So the first component is appreciation. So we have appreciation, and then we have depreciation. The depreciation is the amount that we have written it down. Now we have to recapture that value and pay taxes on it now. So what we're going to do is we're going to point back up to this depreciation value, and we'll make it because it'll simplify the way this looks, we'll reverse that. So we show that the depreciation recapture is $30,136, and the tax rate on depreciation recapture, we'll go ahead and point that to our original setup slide, if you recall, is 25%. The tax rate on capital gains is equal to, we'll go back here and point to that value, is 15%. So the appreciation component is simply the difference between the depreciation and our total capital gain. So I can simply take our capital gain and subtract our depreciation value, and I get the $5,160 is our appreciation. And just to make it look nice, we'll sum these up, and it'll just show us that same value that we've been working with, which is our total gain. And let's calculate out what those taxes are. So the tax rate there, we'll just call that the rate, and we'll put the taxes out here, and it's 15% times our gain, and we'll just drag that down, $774, and we have, I'll make that a little wider so we can see it, $7,534.09 is our tax on the depreciation recapture. And so our total value for our taxes is the sum of those two guys, $8,308. So now we know what our taxes are, and we know what our cash flows are for every one of our periods. So now we should be able to figure out, well, what is this investment worth to us? Well, how much did we put into it in the first place? Because that's really going to be the measure. Is the amount we put into it originally, or the amount we would have to put into this thing originally, worth what we're going to get out of it? So let's take a look at that. What was our initial equity that we put into the deal in the first place? Well, we know that we're going to be buying the building for $325,000, and the loan amount is $243,000. So what would we say our initial equity is? So let's take a look at our 325 minus our 243, and we come up with a value of $81,250. For the purposes of this example, we're going to ignore this cost of improvements because we book that in as an expense. But normally you may want to take a look at that as well, particularly if this cost of improvements is a really big number. So we are going to use this value here. We'll go ahead and plug it in there. We'll point to that value since we already did the math. So our initial equity is $81,250. Well, let's take a look at our cash flows, our after-tax cash flows, and we'll put these for year 1, 2, year 3. So what was our after-tax cash flow in year 1? Well, if we go back here to this sheet, we remember that was $71,5760. What was our after-tax cash flow for year 2? If you remember, that was on this tab. We made it nice and bold. Same thing. And our after-tax cash flow for year 3, just from our regular income standpoint, was the $76,02. Now, what about that before-tax equity reversion? Now, if you recall, that's further up on this same sheet. This is what we're going to get before we pay taxes when we sell the property. We've sold it, we've paid off the loan, we've paid commissions, and we end up with $106,000 and $388. But we get that in the third year. So let's go ahead and point to that guy up there, $106,388.03. And finally, we got to pay taxes on those gains. So let's point to this value. I'll make it negative just so we see those parentheses. And then let's just sum these up. So this is going to be our cash flow for each year. And we'll just sum up all three of these rows here, and we'll just copy that across like so. Well, now that we have all of our cash flows for each year, including our equity reversion and our capital gains taxes that we have down here, we need to figure out whether this $81,000 is a good investment. Is it going to give us a 17% rate of return? So we can do this kind of the old-fashioned way. We can take each one of these values and discount those back to today. The first one is only a year out, so we'll discount that by the 17%. 1 times 0.17. There we go. That's looking much more like it. Now for these other two values, we're going to have to compound those for 2 years and 3 years. So we'll increase that to the second power, gives us the 5391. And that final year, we are going to compound that 3, and if we sum those up, before I hit enter, I'm going to say that the value here, if it is higher than the value that we're going to invest, then that's our go decision. So we're looking for a value, a present value of this stream of cash flows to be higher than the value we have up here. So let's see what happens. 77,494. So it looks like this would be a bad investment, because I'm going to invest $81,000 and the present value of these cash flows is only $77,493. Let me show you another quick way to make this decision. One would be to use the internal rate of return function with Excel, but what we need to do is arrange these cash flows where we have a negative initial outflow of $81,250, and then we have these positive cash flows on into the future. So I'm going to use the IRR function in Excel, highlight these values, and now what it's going to tell me now is the rate of return for paying this out at time 0 and getting these payments in each of the successive years. Anything better than 17%, which is my required rate of return, then I'm going to invest. Well, in this case we get a confirming answer that the rate of return of this stream of cash flows is only 15%. And there's one other quick way. We can compute a present value factor for each one of these periods using Excel's present value formula, PV, and we're going to use our rate of 17% and one period, payment of 0, and a future value of minus $1. And you'll notice if I multiply that 0.85 times my 7157, I'm going to get a curiously similar value to the one I have up here. And I can just move these across, and I need to change these from one period to a 2 period, and from a 1 period to a 3 period. In these present value factors, I'll get rid of those dollar signs again, and as I pull across here, you'll see these same values. So I've just created a present value factor which says that a cash flow I get at the end of the first year is only worth 85% of the value, the face value of it. And if I receive a cash flow 3 years from now, it's only worth 62% today of what that amount that I'm going to get in that future point. So it's just a nice way to kind of see the progression of what this compounding rate does of the 17%. Okay, well, it should be clear that I'm not going to lay out $81,250 to get a flow of cash that's only going to be worth $77,493. So the answer here is absolutely not. There's no way I'm going to invest in this particular option, unless somebody can prove me that it's not quite as risky as that, or if we begin to make some other adjustments and lower the sales price, or increase the cash flows and make some other conservative, some changes to the cash flows. Okay, well, hopefully that helps everyone. It has been great working with you, and hopefully this will get everybody kind of the start that they need to doing some basic real estate investing. All right, goodbye.